Hello everyone, welcome to another video on CPA Exam Lab. Today we are going to do 5 multiple choice questions on cash flow statements. As before, each question is going to be different than the previous one. And in the question, when we are explaining, we are going to show the tricky part and what they're actually testing. And what should you expect today? We will have a question about classification rules, about interest and the dividend rules. We will have a question about the indirect method logic. We will have a question about investing versus the financing activities. You may remember the asset flows versus capital flows. And we are going to have a question about non-cash disclosures, how to report supplemental information. As you are going to see, the questions will be similar to the ones you are going to see in the exam. And each question, there is usually a closer one, which is the tricky part, and we will go over them. And the question roadmap, as before, the first question will be the easiest one, and the last question will be a little bit more complicated. So let's get started. Okay, so the first question is about classification basics. The question is asking us, under US GAAP, which of the following is classified as operating activity in the statement of cash flows, and it says indirect method here. So the options are interest paid on a bank loan, dividends paid to shareholders, purchase of an equipment, proceeds from issuing stock. Okay, so take a moment to think about it. And when we are thinking about operating activities, think about, is it related to the core business, which is the operating activities? Is it related to long-term assets, which is the investing? Or is it related to the capital structure, which is the financing activities? Okay, so if you are ready, okay, here the correct answer is A, which is the interest paid on a bank loan. And here is the key takeaway here. Under the US GAAP, interest paid is always classified as an operating activity. So this is a critical distinction you must memorize here. On the other hand, dividends paid is a financing activity because it deals with returning capital to our shareholders. So let's look at the purchasing equipment. This is the one students tend to choose if they do not pick the correct one. But purchasing equipment is an investing activity because it involves to a long-term asset. And the proceed from issuing stock is financing activity. That one was clear because it deals with the capital structure. So the exam trapeze here is confusing the US GAAP with IFRS. IFRS allows interest paid to be either operating or financing. But when we look at the US GAAP, they are strict. It strictly requires it to be operating activity. If you see on the exam, you may not see in the multiple choice question, but you're very likely to see something related to this distinction on the simulations. Just memorize this. Interest is an operating activity because it is related with the day-to-day operations, and dividends paid is a financing activity because we are returning capital to shareholders. Okay, so let's look at the question 2, which is testing your understanding of the indirect method. It's very hard to do it here. Okay, yes, and we are going to do add backs. Okay, so we have a company. They reported a net income, and they are asking us operating cash flow based on these 3 items. So what are they? We have a depreciation expense, we have a gain on sale of equipment, and we have an amortization of patents. Okay, remember, so we start with the net income, which they showed us here, 80,000, and then we need to make the adjustments. So what do we do when we are making the adjustments? We need to ask ourselves this question. Okay, did this item affect the net income? And did it involve cash? Okay, so if the answer is yes, so that means if this item affected the net income but no cash, we reverse it. because it was reported in the net income and not really cash. And the other thing we are asking ourselves, if it's a non-operating is it a non-operating item? Okay, if it's a non-operating item, we also reverse it because the cash flow belongs in the investing section. Okay, think about how which item impacts that 80,000 net income figure. And on the next slide, we're going to do it together. Okay, the answer is also A here, which is the $93,000. Now let's go over the logic and let's look at the items one by one. And a couple things you have to memorize here. Okay, so the first thing is depreciation and amortization. When we see them, we know that they are non-cash expenses. So meaning that when we reported the net income, we reported them as an expense, but actually no cash left the company. So as a result of that, we are going to add them back. So we are adding back that $15,000 and there was an amortization of $3,000. And here is the exempt wrap here, which is the sale of equipment. Because when we think of the sale of equipment, we know that there was a $5,000 gain and that increased the net income for us. But the question was asking us the operating activity, and the issue is it is a part of the investing activity. So in order to isolate that the operating cash, we must subtract that gain back out. So as a result of that, we are reversing the effect on the net income, which we are subtracting $5,000. So let's look at it here, $80,000 plus 1595.98 minus 5,000. The correct answer is $93,000. Okay, so always remember here, reverse the sign for gains and losses on asset sales when using the indirect methods. Okay, so question 3 is medium difficulty, and now we are shifting our focus to the second major component of the indirect method, changes in the working capital accounts. These are the current assets and current liabilities that are not cash. So here we need to determine the net adjustment to net income based on these changes. Accounts receivable increased, inventory decreased, and accounts payable decreased. So the key is understanding the relationship between the change in the balance sheet accounts and the resulting cash flows. The question we are asking ourselves, does an increase in an asset mean more cash or less cash? Or does an increase in a liability mean more cash? Cash was spent or cash was received. So like when you think about it, it's logical. You use your intuition, and the golden rule of cash flow is the figuring out the net income. This is where many students get tripped up. Here in our question, we have green fields. They have all those changes, and the question is asking us what adjustments we are going to do on the net income. Okay, once you're ready, on the next slide, we're gonna do the answer together. Okay, so the answer is also A here. I don't know if it was intentional, but let's apply the golden rule here. Okay, for assets, the relationship is inverse. So what I mean by that, accounts receivable increased by $10,000. So that means we made sales on credit that increased the net income, but we haven't collected the cash yet. So basically we got those people owe us $10,000. We showed it on our net income, but we do not have that $10,000 yet. Therefore, we subtract that $10,000. The second thing is looking at that inventory. Okay, so here it tells us the inventory decreased by $5,000. So that means we sold more inventory than we purchased. So that means we freed up cash. There's less inventory right now. We sold it and we got cash for it. So we add that $5,000. And the third one for liabilities. Okay, so for liabilities, the relationship is direct. So what I mean by that, accounts payable decreased by $2,000. So this means we use cash to pay down our supplier. So that means cash went down. So we subtract $2,000 and summing all the adjustments minus the 10,000, minus 10,000 plus 5,000 minus 2,000 here equals to net subtraction of $7,000. Okay, so that quick tip is accounts payable is huge. So a decrease in a liability almost always means a cash outflow. Okay, so the next question will be about activities into investing versus financing. Okay, now we are on question number 4, and this is a pure classification question. And this is a common way to CPA exam test your knowledge of the 3 cash flow sections. So the question is telling us we have a company, they had a following 5 transactions here in year 1, and they are asking us the net cash flow from financing activities. So here we are looking at the issuing of common stock, purchase of treasury stock, paying dividends, and selling an equipment and purchasing lands. So basically we need to look at the noise that does not belong to our financing activities. And as a tip here, when we think of the financing activities, those are the things they are related to debt and equity capital. So think of them as dealing with the owners and the long-term lenders. And take a look at the question. Once you're ready on the next screen, we're gonna do it together. Okay, the correct answer is B. This time it's not A, fortunately. Okay, this one, the logic is they were basically asking us which one was related to financing activities. Remember, the logic is the financing. Those are transactions with owners and related to borrowing principal. But if we see something that is interest, remember that's related to operating. And if we see something about long-term assets, those are related to investing. So in the exam, you may see things like repaying the principal debt, that's financing, but paying the interest on that debt is an operating expense. Like they like to test this distinction. So when we look at here, okay, so when we look at here in the question, the ones we had to exclude that they were noise is the interest one and the equipment one, because one is operating, the other one is investing. And when we look at the numbers, issue stock of $50,000, they repaid bond principal, so $20,000 cash outflow, and paid to dividends, which is the payment to investors. It's a part of the financing activities. 20, 10, 30, 50 minus 30 is 20,000. Okay, so now we are moving into a question about statement of cash flow disclosures. Okay, so this is a common exam topic that tests your understanding of what belongs in the body of the statement versus what belongs in the notes. Okay, so the question is asking which transaction requires supplemental disclosure. Here, I can't type, okay. Supplemental disclosure. Okay, what are the options here? Acquisition of equipment by issuing a 5-year note payable, payment of cash dividends declared in a previous year, purchase of a treasury stock with cash, and recording a depreciation expense for the year. Okay, so here think about the fundamental purpose of the statement of cash flow. Like it's right in the name there, cash flows. Okay, so which of these transactions did not involve the movement of cash? That would be one way to look at it. And once you're ready, let's look at the answer together. And here the correct answer, even though here it says C, the correct answer needs to be A, issue buying an equipment with a note payable. I don't know where there's an error here, but if you did the answer is A, that's the correct answer. I'll go a little bit more detail why it is A. But let's start with the golden rule. The golden rule here is that if there is no cash, it is not in the body of the statement. This one, memorize this or learn this one is actually very logical because what statement are we talking about? Statement of cash flow. Okay, is cash involved? Yes, it's in the body. It's not involved, then it is going to be in the bottom of the statement or notes to financials. And why do we still report it? It's because it might be relevant for the readers of the financial statements. So even though if there is no cash, if it's something important that's important operating, investing, or financing activity, we show it there. Okay, here finally you can see the correct answer, which is A. All right, just do it A. Okay. So now let's analyze the options using our golden rule. Okay, so what did option A say? It was acquiring an equipment by issuing a note payable. So it is a significant investing and financing activity because equipment is an asset and a note payable is a liability. And in this transaction, did any cash move? No, no cash move. So therefore, this transaction requires a supplemental disclosure. Now look at to option B. Option B is about paying dividends. So paying dividends is a cash outflow and goes right into the financing section. And look at the option C. It is about purchasing treasury stock with cash. It is also cash outflow and it also goes into the financing section. And when we look at option D is about depreciation expense. It is a non-cash adjustment. It is added back in the operating section under the indirect method, but it's not a supplemental disclosure item. So here the correct answer is A because it's the only one that is major investing or financing activity with zero cash involved. So here's a classic exam trap. Make sure you understand the difference between a non-cash adjustment like depreciation and non-cash transaction not for equipment. Now let's wrap up, take key takeaways. Okay, so in that 5 question, we covered a lot of ground, but let's consolidate the 5 most critical concepts. So the first, remember that interest paid is always an operating activity under GAAP. Don't let the exam trick you into putting into in financing. The second one, when using the indirect method, you must add back non-cash expenses like depreciation and any losses. Third, master the working capital rule. Current assets are inverse and current liabilities are direct. Fourth, distinguish between principal and interest. So principal repayment is financing, but interest is operating. And finally, always disclose material non-cash investing and financing items in notes or not in the body of the statement. If you master these 5 points, you're ready to crush the statement of cash flows questions. Now let's move to the next section where we will look at a full simulation. Today we covered the core concepts, but let's talk about how to crash these questions on exam day. So your strategy for success is simple. So classify before you calculate. So this is the single biggest mistake students make. So you need to label every single item in the problem as operating, investing, or financing before you even start or adding subtracting. This prevents you from falling into the exam trap of misclassifying a non-cash item. Next, use your scratch paper. So in the exam, they give you scratch paper, and if you want extra, you can just raise your hand and they literally bring you. Use them and write down the rules. It's 3.5 hours, 4 hour exam, you get tired. Write down that increase in an asset is an inverse relationship to cash flow and increase in a liability is a direct relationship. So if you refer this to constantly, you will avoid the simple errors. And investing activities are reported at the gross amount. So if the problem gives you a net number for equipment, you must pre-construct the T account and find the gross purchase and the gross sales. That's where the cash flow actually happens. And use 3 steps and you'll solve the problems faster and more accurately. Now let's look at the immediate next steps to lock in this knowledge. Okay, so what do you write now to make sure this material sticks? So it's practice, like literally practice. So you go and do at least 20 multiple choice questions and that focus on all classifications. Okay, can you identify operating, investing, financing for every transaction? If you struggle with the indirect method examples we went through, stop and rewatch that concept video right away. Foundations are important. Don't let a weak foundation to undermine your whole approach here. And once you feel confident, your next step is to watch our cash flow statement simulation video. Over there, we'll take everything we learn here and apply it to a full document review task, which is exactly what you will see on the CPA exam. Thank you for watching.